Welcome everyone to this webinar hosted by the World Federation of Exchanges. My name's James Auliffe. I'm a Senior Regulatory Affairs Manager at the WFE, and I focus on tech and market structure issues. Before I get my panelists to introduce themselves and make them do some work, I am just going to do a quick plug for the WFE. So we are the global trade association for exchanges and clearinghouses. We represent about 250 pieces of market infrastructure all around the world. That's emerging markets and emerged. I like to think of us as having sort of three key roles. The first is my day job, that's advocacy for exchanges and CCPs with regulators and international standard setting bodies. Then we also have a education mandate. We try and share best practice amongst our members, but we also try and educate the general public on the value exchanges that bring to society. And we also have a market infrastructure certificate that we run with London-based business school. And finally, we have a research function. So we have a team of economists that do academic research of critical interest to exchanges and CCPs. And we are also the definitive source for exchange traded statistics. You can sign up for that data on our website. If you are a member already, feel free to get in touch. Just make sure you're making the most of your WFE membership. You can reach out to me or anyone on the team. We'd be very happy to have a chat. And if you aren't a member, why aren't you a member? Get in touch and we'll talk about membership. Okay, my plug is now complete. I'm going to turn to my panelists and get them to introduce themselves. Alf, why don't we start with you?
Thanks, James. Hi, everyone. My name's Alfred. I am the Senior Sales Manager here for ASX's Technical Services business. So I lead a sales team that's primarily focused on growing our community of firms within our exchange colo. Across our suite of connectivity services, and more recently, what we call Colo on Demand, which is our infrastructure as a service offering powered by Beeks. Really, my day-to-day is talking to financial markets community members down here in Australia, helping them to deploy, optimize, and achieve their goals in our little corner of the world. I've been in you call it capital markets technology space for close to 20 years now. Initially on the trading side, but now at the ASX. It's a little bit about me.
Thanks, Alf. Graeme.
Thank you, James. So yes, so I'm Graeme, working in the sales team here in APAC for Beeks Group. So Beeks provides compute analytics and connectivity resources for financial markets. And my role here is based in Singapore, doing sales, managing some of our key accounts in the region, including in Australia, but also looking to grow the business out here. I've been with Beeks for a number of years now. Prior to that, I was in a tech background, working at some large firms and some startups. So, good to meet you all.
Rob.
Thank you. I'm Robert. I am doing pre-sales with Beeks at the moment. I'm based in Sydney. I'm also looking after Asia. I'm providing a lot of the technical side of things to the sales team. Also, obviously, to the ASX team and their on-demand offering. Prior to that, I was in a trader voice market. So working with infra with Beeks is very similar, but the exchange marketplace is quite a new and exciting one that I'm enjoying working with at the moment. And that's probably it from me. Thank you.
Thanks, guys. Before I get into, I've got a couple of questions that I'm going to pose to the guys in front of me. If you have any questions, if participants have any questions, I'd encourage you to put them into the sidebar. I will just drop a message in there in a second. And I will either try and weave them into the questions I've already got, or we'll come back towards the end and pick up any questions. Okay, so let's get into it then. Graeme, what are we here to talk about? What are barriers to entry and what are the current trends in the market?
Thank you, James. So barriers to entry, I think a lot of people on this call will probably have a fair idea of what we're going to be talking about today, but it helps, to simplify them as much as possible. And to think of yourself as a financial entity, if you're looking to trade on a specific market, The barriers to entry are those obstacles between where you are now, not trading, and where you are trading. So it's all the things you have to overcome to get to the state you're looking to get to. These can be a variety of things, but some examples would be cost, time frame, complexity, and risk. And cost is a very prevalent one, of course, and it defines obviously whether something is viable. So do you have the financial capital required to actually put yourself in the position to trade here? Can you get the infrastructure in place? Are you able to get sign-off internally for that? Never mind, do you have the money? So this often dovetails with risk as well, where you've got to make a case internally for something because it can really skew your success criteria. You're having to put up a lot of capital to even start at something and test it out. Time frame is another one. So we're going to talk a lot about this today. I think we're going to talk a fair bit about how things are moving more and more quickly and how time frame is becoming more crucial. It's an uncertain world. Trends move quickly. Technology moves quickly. Geopolitical things happen. So often your ability to react to things, to take advantage or to mitigate your risk is what makes it viable or not. So the time frame, if you're going to take X amount of time to even get started in a market, it might make the whole thing moot because you're simply not going to be able to set things up in time. Complexity is another one, and complexity is quite broad in many respects. It can be a whole range of things, but it can often be the unknown unknowns that crop up when you're dealing with something that's new. So if you're used to a market, but you're not used to this new market that you're looking to expand into, you might think you can take the learnings from here and apply them, but actually often that's not the case. There's all sorts of new bureaucracies for you to get involved with. There's all sorts of different, even things like tariffs that come up, all the different supply chain issues that can arise when you're just not used to something and you don't have the expertise for it. So the complexity becomes apparent in many, many different ways, and it can often be what derails things because you're not expecting it and not planning for it. And then risk is the last one I was speaking about, and this is kind of what ties everything together. You have an appetite internally for risk. The regulatory team internally for a financial institution may have an appetite for risk, and all of these different things we talk about are going to affect whether they believe that it's worth taking the risk to make the leap into this new market. So it ties together all those different things above. And what we find with the market just now is that the trends you asked me about, people are not having any more appetite for risk, but they do want to move faster. So they want to be more reactive. They want to take advantage of the innovation that I was talking about. So technology moves more quickly. They want to take advantage of the changes that we're seeing across the world just now, whether that be new technology, things like AI, of course, is going to be a huge part of what we talk about. But also, again, those geopolitical bits and pieces that throw themselves up from time to time and are just unexpected. So people want to be quick, they want to be agile, they want to move, and they want to take advantage of things, but they want to do all of that while ensuring that they're not taking undue risk with it.
Thanks. I think that's a really good explanation. How does that tally with you, Alf? And how do you think the market shifted in recent years with regards to firms accessing exchanges?
Yeah, thanks, James. Look, maybe I'll start with a bit of context about our particular situation at the ASX and what we've done. So we've been operating our exchange colo, the ALC, the Australian Liquidity Centre, for about 13 years now. Our vision for the ALC was not just somewhere that we could house our matching engine. We sort of had grander plans than that. We wanted to build the home of the financial markets in Australia and in region out there. We wanted a really bespoke financial markets community. And we've been largely successful at that. We've brought together some 200 plus financial markets firms, not just trading firms like banks, brokers, HFTs, etc., but also the service provider community. So data vendors, software vendors, the ISVs to the financial markets, clearing providers, etc., all purely focused on Australian and international financial markets. And what we've seen is traditionally these firms build their own and manage their own physical infrastructure on this premise and at their data center. Typically, they'll have 1, 2, sometimes 3 data centers, dedicated connectivity, really highly bespoke environments that are operated and managed, and they need to refresh themselves on an ongoing basis. But I think the big shift that came, at least in my mind, is cloud adoption. We all know that's become really entrenched now. We're definitely seeing it among our clients. We're seeing widespread use of public cloud, primarily for middle and back office functions, and those firms are seeing great benefits to that. We as a company are also doing this. But I think firms are becoming a bit more accustomed, or they are becoming accustomed to the benefits of cloud, and they want to apply these benefits increasingly to front office use or front office functions. I'm talking here about trading, execution, multicast, market data consumption, and processing. And these functions will typically sit in a client's cabinet in an exchange colo. So that's driven a bit of a shift to a more of an infrastructure as a service model within exchanges. And we've seen obviously firms like Beeks partner with exchanges and develop businesses and products in this space. I guess importantly, latency still matters, and there's a large segment of the market, HFTs, where proximity to the exchange remains critical. So we're seeing a bit of a hybrid world emerge. Some workloads are moving to public cloud, others need to stay close to the metal, and some are shifting to private clouds and infrastructure as a service as a result. So I guess the shift, what that means is firms are moving to more flexible consumption-based infrastructure models. They're leveraging cloud. Obviously, it's a bit more of a hybrid cloud setup these days, rather than building everything themselves in their own data centers. But I mean, a few other big shifts as well. There's been an explosion in data volumes, analytics, increasingly in our experience, AI-driven models within the capital markets, and those are driving a huge demand for compute and storage. Automation is another one. Automation in the way they deploy physical infrastructure on site. Automation in the way they enter new exchanges. And this is also kind of bled into network connectivity with some of the technologies we're seeing there. We're still seeing continued growth in electronic trading. That hasn't slowed down, but across asset classes, not just equities, but fixed income, derivatives. So that's driven a need for more standardized, scalable access models. And if that wasn't enough, we had this little thing called COVID, multiple wars and supply chain disruptions. And while I don't think these things are causing this shift, they've definitely accelerated it because of things like procurement, things like this. So in summary, the shift is really from bespoke, manual, fixed environments to more nimble, scalable, and increasingly hybrid ecosystems. So all of this is good news, I think, for exchanges, because it has the advantage of making it very easy for newer firms to enter new exchanges, but it's also positively changing the way existing firms access our markets and evolve. I'll leave it there.
I think that tallies a lot with what I hear from other exchanges as well. In particular, thinking about how you'll introduce a new technology, say middle or back office, and then graduate when you start to understand how it works, moving towards more front office stuff.
Yeah.
And good to hear that there are advantages for exchanges and more growth. That's what we like to hear. Rob, what about time to market makes it important? That's what one of the key questions we want to answer, right?
Yeah, thanks, James. Look, for any new participant to the market, there's going to be a lot of challenges, and I think Graeme and Alf have outlined a lot of these already. I might focus a bit more on that. So whether they're coming to an exchange for a particular product or possibly its location, those challenges might be a little bit different. So maybe we look first at some of the bigger players like a bank. They might have the time and the ability to build out their own infrastructure, very specific to their needs. And we should point out that they do have often very specific needs. Every bank's got its own standards. They're going to be around, global security, governance, compliance, regulatory needs, and they all like to do them in their own particular special way. That also means that they're going to have a lot of internal or interdepartmental bureaucracies around that, that they can't really move quickly. If they decide they want to move on a new product or a new location, they could take months or even years just kind of getting through those internal hurdles, even before they reach the point of procurement. Procurement's obviously another challenge altogether, which I'll come back to. But smaller players, look, they're going to be a lot more agile and nimble. They can move faster. They still have to build out trading infrastructure, and trading infrastructure is complex. So not only do you have to sink a lot of risk into the capital to invest in product to build it, you've got to have the right resources, you've got to have the right people to put it together, to project manage it, to build it, to test it, to make it ready for production. None of that's really quick. And often some of these smaller players just kind of look at a new product or a new market and they assess what they need to do. And at that point, they shut down. And I think Alf's probably seen some of those come to the doors of ASX in the past, entertained the idea, and then the barrier to entry has just been a little bit too big for them. So moving past that, we get on to the supply chain delays, which has been mentioned by Graeme and Alf already. We've all seen what happened with COVID, with the Taiwanese chip shortage, with the Ukraine war, etc. At the moment, we're looking at what's known as AI-mageddon or memflation or Ramageddon, it's also being called. And basically, all of the hyperscalers have pre-bought all of the memory, the RAM, the solid-state disks, the SSDs. That they've pre-bought all of that for the coming year to build out AI-ready data centers. Whether that happens or not, we don't know, but they've absorbed all of the world's stock on that. So Gartner put out a forecast just last week. RAM demand was up by 125%. And SSD, solid-state disks, by 234%. And they're forecasting supply crisis until at least 2027. So if you're in the market for a new infrastructure, new server, you'll go to get a quote, assuming you can even get a quote quickly. There will often be a 24-hour validity on that quote. And assuming you can make a decision on it, you're talking kind of 6 to 12 months potential delivery, which is just, untenable. And the 24 hours to make a decision on that, smaller firms might be able to do that, but the bigger banks just aren't going to be able to cope with, with that sort of timing. So basically, whether you're a new entrant to the market, if you're small or large, it's the risks with capital and resource to build the trading ready infra that's going to stop you. And this is, I guess, where we get to the time to market. So assuming you can manage to build your trading stack, the market might have moved, right? So you're going to lose your competitive advantage. In situations like with the ASX, where the exchange has already pre-built those trading stacks, they're de-risking the capital investment and the time, and they're turning all that into an OPEX spend for new entrants. So with a product like Colo on Demand that ASX have, new entrants can remove all those barriers and they can come to a new market or a new location and they can start trading pretty quickly without those barriers being there. So that's definitely reducing the time to market.
Thanks, Rob. I think we covered a bit of this already, but Alf, what's slowing down firms when they want to access ASX?
Yeah, look, I mean, it sounds pretty straightforward, right? Access a new exchange. It sounds like a straightforward technical hookup, but when firms approach us looking to connect, in reality, there's a few layers. There's a few layers to the process and a few areas where some of these bottlenecks can stack up. But generally, I think I mean, from my experience, right, I think the delays usually come from a mix of infrastructure, compliance, and then just coordination of all of the above. But in terms of infrastructure and connectivity, before they even start anything, these firms have to, or these teams have to secure project resources, funding internally. That's before anything has really kicked off. Then they would approach us. They would need to order rack space, power, cross connects within our colo. And again, that's still the easy bit, right? Then they come to actual procurement of the hardware, and then they have to order it, ship it, rack stack, configure it, or work with someone in region to do that. And all of this can take weeks, if not months. Give you an example. We're actually in our colo in the ALC. We're very close to capacity, and we've had a lot of firms are reserving space at the moment because they know they're coming up to deployment of their infrastructure. But we've got a firm who commenced their reservation on their cabinet space towards the back end of last year, November. And they're in the process of provisioning infrastructure now. And I spoke to them recently, and they said they probably won't be in a position to deploy their kit before the end of the year. And that's not just obviously procurement, but that's everything, right? Coordination and getting ready to proceed. So all this just adds time and effort. I mean, and then there's the network connectivity design and deployment and getting back to colo. So those are the big things slowing firms down. There's obviously other things like certification, regulatory compliance, but those tend to be sort of outside the control of those firms. But you think about all these challenges from a perspective of a small trading firm, like a startup quant or a startup prop trader, who often have really small teams and small budgets. These challenges don't slow them down, James. They pretty much knock them out, right? In a lot of the time, and we lose them. You know, over the years, I've had so many conversations with trading firms, and they get to this point, and you lose them because the cost, the complexity, and the risk is too great, and then other priorities come along, and they move on. So that's been our experience.
Yeah, that's frustrating. By the sounds of it. I guess what you're trying to think about then is things that like the reg compliance point was an interesting one for me. Like the things that you can, as a firm, take control of, and this is one of those things, right?
Yeah, exactly.
So Graeme, what is it about Beeks offering that helps reduce this friction?
Yeah, so I think this is all tying in with the issues that Alf is raising there that people are having. So what Beeks is trying to do with the infrastructure models we have is taking the infrastructure piece from a constraint to an enabler. That's the idea. So moving away from the idea of these build heavy models to a more on-demand structure. And what this allows you to do is it allows you to spin up and down things as you require, as your demand requires. And what that means is that you can minimize your exposure to risk. So you're able to maximize exposure to things that are doing well. You're finding this is working. We want to take advantage of it. We want to move quicker. We want to take more compute in this area. You can do that really quickly. And if something isn't working out so well, because of that flexibility, you're able to pivot. You're able to minimize your exposure. And we find that in this ever-changing world, when people have to secure these internal buy-ins all the time, and they need to make decisions on a long-term basis, the ability to continue to be agile is really important. Another thing that we have is, because we talk about this colo on-demand piece with ASX, and it's something that's core to Beeks, is they enable the ability to spin up things quickly and provision environments quickly. So instead of putting together something over months, perhaps, you can put something in place in days, even hours, if it's just virtual compute. And again, that all ties in. So it's this idea that instead of this really long timeline between you now and being able to trade, being able to test even, you can do it quickly. Part of why we can accomplish that is because there's a standardization element. So there is, we can talk more about customization as it comes up, but there is a standard offering there that Beeks has that's in location, ready to go. That's why you can feel yourself of it so quickly, and you can get exposure so quickly. What that allows you to do, because we've designed that for these financial markets, we know what clients are looking for. We've got experience all over the world of what people need from a spec perspective, what they need from connectivity. So we know what the standard options should be. So you have various different sizes, and these are there. They cover the vast majority of the market. People can come in and use them very quickly. And another thing that we think is a real advantage here is the CapEx versus OpEx piece that we've discussed a little bit already. A lot of firms, if you're looking at a big CapEx spend, we have so many clients come to us. I've had several conversations in the last few months where someone has basically said to me, someone senior at a financial institution has said, we just won't get sign off for a big CapEx spend on this. It's not a priority. We don't have the internal momentum. The CapEx, like Alf was saying, it's not going to slow them down. It's just going to kill the idea. So that's a really important thing. We allow people to spread it over time. And again, crucially, when we're talking about these supply chain issues, talking about how changeable the world is, the Ramageddon and all the other names Rob had there, some of which were new to me. What that's doing to so many people is it's stopping them from being able to plan in advance because they just don't know what the costs are going to be. Whereas if you take something on a platform like this and you sign a contract for a period of time, we're able to keep those costs consistent. So you're paying this monthly, it's going to stick at this amount or X amount, there's going to be changes that are pre-agreed. Means you can plan more effectively. It means you can sign off things saying, well, I know what our spend is going to be. I know it's not going to balloon out of control. Whereas if you're trying to do it yourself, it's really difficult to do that because you just don't know what's around the corner. If you were looking at something in February last year, by the time the tariff conversation hits in April, everything changes. If you were looking at something in February this year, it's the exact same with what's happening in the Middle East. So I think the top line really is that the Beeks offering allows you to launch new venues and new services faster. It allows you to scale in line with the demand, both up and down if required. And it reduces your reliance on those kind of lengthy procurement and setup cycles that can really slow you down, or as Alf said, can completely nix the entire thing.
Thanks. I think the geopolitical element's really interesting. I mean, I think everyone's talking about it, but it's really interesting to think about like how it actually affects firms on the ground, right? Alf, what's this model meant for ASX commercially and its clients?
Oh, look, I think fundamentally for exchanges, we're broadening our ecosystem. And that obviously has commercial benefits for us as an exchange. It makes it easier for firms to enter our market. I think, look, our two goals are to attract trading firms. Obviously, we want to increase liquidity. We're a financial exchange. And we want to attract vendors because they enrich that environment. They make connectivity costs come down, enlarge our community. Generally makes things a lot easier, cost effective, and simple when we have the whole community in one spot. So this helps us bring in more clients, not just that top tier, but that long tail of clients where colo will otherwise be a luxury item. So it allows us to really widen our target client list. And onboard them much faster, obviously, for the reasons that the guys have mentioned. And at the same time, it's growing ASX's revenue because it's essentially a new product line for us, right? So traditionally, we sell a client space and power and connectivity, obviously, to exchange services. Now we're selling them the space, power, connectivity, and hardware and compute, which is something traditionally that we've never done. So we go from having X amount of product to provide to a client to that much product to provide a client. So it's a new product line. And those three words, new product line, is really what was really a game changer for us as an exchange. Operating data centers is largely seen as a cost center these days because it's expensive. So any new product in this portfolio is welcome. One thing I'll just add too, it's helped us densify our colo as well. If you think about, we're almost full, as I said earlier, but there's still a lot of clients that occupying a contract with us for a full cabinet, but they only might be occupying a third or half of that cabinet. What we're saying to those clients is, well, why don't you migrate to colo on demand? When your refresh cycle comes along, migrate to colo on demand. It's good for the client for all the benefits we've been talking about, but it's good for us because then we can take that cabinet and sell it to a client who can more fully utilize that space, that power. So commercially, that's good for us because we're sweating our asset a lot harder. We're generating a lot more revenue from the existing asset. And it's coming to be a serious problem now because we're so close to capacity. So anything that can help us at the edges like this is fantastic for us. But I think in closing, this model, infrastructure as a service, colo on demand, it's really turned infrastructure from something that slows firms down into something that speeds them up and something they can consume on demand. So commercially for us and them, it's an absolute win-win.
Can I just dive a little bit deeper on colo on demand? So it's essentially the idea is that if the client's demand increases, you can just offer them more compute space, right? And if it decreases, then it goes the other way.
Yeah. So Beeks have pre-built, pre-configured this environment. Sits at the center of our colo. In fact, I started taking clients past it for data center tours because it's quite interesting. We put some branding around the space, and it's a pre-built environment full of servers. We've opted to provide 3 flavors of services because you want to standardize as much as you can. We've picked and deployed those 3 server options, and they're sitting there pre-racked, pre-configured. So they're ready to fly off the shelf and be deployed for a particular customer, be it new or existing in colo on the other side of the room. And it's fully integrated with our existing environment, meaning that trading, market data, clearing, settlement, connectivity can go directly into your colo on-demand server, bypassing the need for a cabinet. So very interesting proposition and something that we've never done before.
Yeah, it's a really cool idea.
Yeah, it's when I first started breaking it down mentally, I was like shocked at how simple it is, yet how such a fantastic idea it is. And I think
best ideas are like that. Right? You're always like, why hasn't someone thought this already?
Yeah, a lot of clients have a sort of a light bulb moment when you break it down for them.
And just going back on something you were saying, Graeme, maybe Rob wants to jump in on this one as well. But you're talking about you've got like a standardized offering, but you can also do customized stuff as well. Do you want to just talk a little bit more about that?
Yeah, this is very relevant as well because it does come up from time to time, and it comes up for a variety of reasons. So sometimes customers will be looking for their very custom setup for a very good reason. They might be running something very, very specific that they know, they've tested, they know runs on this, and they require this. Sometimes they're just used to the spec they have. That can also be what comes up. So the way we run it is we have these standard options that I'll discuss there, and they are designed to meet a variety of needs. And what's also an option is taking more than one of them, of course, if you're looking for more compute. So it's one of those, the idea between customization and standardization, it's really about the priority of the customer. They're looking for something that can be deployed quickly, that we know works and we know is available right now, they can opt for the standardized option. If they want to explore custom options, then of course there's a conversation to be had. There's obviously going to be a commercial conversation to be had, and it won't be as quick. So that's the thing. We're going to have to do something bespoke for them, and that's fine. It's doable, but again, it depends on their priority. So it's good to have the option there, and again, it depends really on the client need. But again, it's that agility. If you want to move quickly, it's there. If you want to move in a very specific way with a very specific specification, that's also an option.
That's great. Sorry, I meant to say 2 seconds ago as well, when you were talking about bringing more liquidity to the market, and Alf, when we actually did some research, our research team were looking at this and like talking about how much the amount of liquidity in your market affects also like whether issuers will list on your market as well. So it's not just you're getting more liquidity and more, well, in the positive sense for ASX, more trading revenue, but you're also potentially bringing new issuers to the market as well.
For sure. I think it was JSE they've done this in a highly successful way, sort of pioneered this and are doing this with Beeks, but they've been able to, and I was reading this on publicly available material, I think it was an annual report, they've been able to correlate them bringing in Colo 2.0, which is their version of this, and a direct jump in liquidity and trading volumes on their market, like as a direct result, and they've been able to put that in their material. So this can have a market shift in liquidity and attracting liquidity to an exchange, especially one like them, sort of like a smaller exchange in a regional market like that.
Yeah, it's often the discussion we're having with our more emerging market members, I think.
That's what I meant, emerging markets.
I'm sort of coming towards the end of my list of questions, so I'm encouraging participants in the webinar to send a couple, but I have got one already. So having a pre-built or on-demand infrastructure offering looks good for new participants, but does the exchange carry any risk from offering this? I think that's for you, Alf.
I mean, of course, we carry risk. We drew up a business a proposal, a business plan internally, for a business case rather internally, and we assessed the various risks involved in doing something like this, and we did our due diligence about what other exchanges are doing. I think we weighed up the risk. I guess one was the risk of going ahead, the risk of not going ahead, and the risk of potentially going ahead but doing it all in-house. And we balanced. On balance, we came to the conclusion that doing it ourselves was a high risk. That's because we have a very large technology roadmap underway at the moment, out to like 2030. We're currently upgrading our CHESS, or clearing and settlement platform, our cash market trading platform, our derivatives and clearing platform, and we manage our own colo facility. So we got this massive technology program underway. Carving out resource to do this ourselves is probably a high risk, and we don't currently have the appetite to do that. It made more sense to partner with a firm that's, sort of best in class, understands the financial markets, has done this with a number of exchanges now, and do it that way. But I think the key takeaway from that, from a risk perspective, is we felt that doing nothing was the biggest risk.
Makes a lot of sense. I don't think I know you're not alone in having a lot of core infrastructure upgrades ongoing. I did a small survey of our CTOs, and and a lot of them are doing core system replacement upgrades, and it's like the most important thing that they're doing at the moment. So, Graeme, were you going to come in?
Yeah, I was just gonna add a little bit to what Alf was saying. I think something that we found, something that resonated with clients over the years that we've been able to make them see the value in is the core competency of installing and running this infrastructure. It's what Beeks does all day, every day. So we have the 24/7 support team based in the UK that follows the sun. You know, as Alf alluded to, we've done it with a variety of exchanges. We've seen a lot of the different things that can happen. You know, every time we go through this, we learn from it. And the exchanges, they all have slightly different needs, but you know, they're all broadly trying to achieve the same thing. So we're able to work with them and able to iterate each time to make it better. And what partnering with someone like Beeks does is you get all of those learnings packaged as part of it, and you don't have to go through them yourself. I think, you know, I'd said earlier about complexity can mean many things. It can mean the complexity of the setup itself, but it can also just be all those bits and pieces that you don't anticipate. And I think with something as complex as setting this up, often if you can leverage the expertise, you know, the institutional expertise that someone like us at Beeks have, it can make your life a lot easier. And that can be both in the installation phase, it can be in looking to maximize the exposure that this has and generate interest in it. And it can also be in the ongoing upkeep and growth of it. You know, rather than you learning all of these things and encountering all of these obstacles yourself, you're encountering the obstacle that we've already encountered and we've already figured out how we got over it last time. So I think that was just something I wanted to you know, reiterate after Alf said there.
Yeah, thanks. I've got another question. WFE recently warned exchanges about the risks of inaction to market trends and losing liquidity via fragmentation for not keeping up. That's still something that we're concerned about for sure. While it was specifically about extended or 24/7 trading hours, could the same be said about time to market causing risk for exchanges of the same fragmentation? I mean, I would just start by saying that it's not just a 24/7 question, the fragmentation point, particularly in the US and Europe. But sorry, the question was, what could the same be said about time to market causing risk for exchanges of the same fragmentation? Does anyone want to take that question for me?
Yeah, I can have a go at that. So as the market's moving, the exchange has to move with it. If you've got pre-built on-demand infrastructure, like for example the ASX has, it means that participants can join easily and they don't have to go seeking other liquidity, because you are seeing fragmentation in the exchange market, right? Whatever the barrier happens to be. So the WFE's recent warning was that the barrier being extended hours trading. If the barrier was that we can't get to market quick enough, it's going to be the same thing, that they're going to go and seek other ways of doing it. So yeah, I'd say in that case, time to market causing the risk of exchange fragmentation or participants not coming to that exchange's pool of liquidity is pretty much just the same risk. And yeah, for someone like ASX who has that mitigated with their own ready-to-go trading platforms on demand, they're covered.
Yeah, I agree with all that. I mean, a lot of the trading firms we talk to, especially the smaller ones, they have a limited pool of capital. They're going to allocate that. They're going to allocate that in the path of least resistance. If you've got various exchanges or your competitor exchanges in region doing things like this, it doesn't just have to be infrastructure as a service. Anything, if they're innovating, they're more likely to attract that pool of capital. So I think it's self-evident. Would be my addition to that question.
Thanks. So another one's come in. What automation is involved in the solutions ASX use? I think you talked about automation already, right? And how does this result in participants getting to market quicker? Do you want to take that one for me, Alf, or someone else? I think.
Or do you want me to grab that, Alf?
Sure. Yeah.
So I guess before talking automation, I think it was mentioned before about having kind of, standard flavors of pre-built trading systems ready to go. So you've got to reduce the complexity at the point of sale side, but also at the back end. If you want to deploy that, the quicker you can deploy it, the better. And that's kind of where the automation comes in, where you've got people, clicking options in websites and writing code and doing whatever's needed to do to configure. You've also got a lot of room for error. It's going to take longer. The more you can automate that, and this is kind of one of Beeks's main focuses at the moment. For example, we give the ASX a portal, and when they have a customer who comes along, they can do everything they need to do from that portal, and the automation will take care of that, and it will then deploy either virtual or bare metal servers for their clients, and their clients get access to the same portal. So all of that's done with automation. And it ultimately just makes it quicker and more reliable. I don't know, Alf, if there's anything else you wanted to add to that?
No, yeah, that's all. That all makes sense. Yeah, I'll just add one thing. It's that this is automation for us too. Back to my point about if we were to do this ourselves, we would have to expand we'd have to expand the role and responsibility of our own data center connectivity teams. So this is us automating the deployment of servers for end clients. So yeah.
Thanks. Another one. Do ASX currently offer any sort of trial for their on-demand service for clients who are only looking to test the market? Are there appropriate offerings?
Testing, yeah, like we're open to doing that sort of stuff, James. We sometimes have proof of concept periods for clients to test out things, but largely it tends to be quite simple. Clients don't typically need that too often. If there's a special use case or something a bit different, or they have a particular concern, we might add a trial period to that. It's not standard, but we're quite flexible, and if there's a case there, we were happy to support clients. But so far, I think we've had one client who's requested a proof of concept period, but that's a particularly large and a bit more of a complex deployment, and that client is shifting from an existing cabinet to they're already a tenant. They don't want to manage their own gear anymore. So we've, obviously they've got concerns around this migration, so we've allowed them, ample time to settle down in colo on demand.
Yeah, to play around with it first. Okay.
Yeah.
Makes sense.
Could I add something to that, possibly?
Yeah, please.
I was just going to say we have seen both with the bigger and the smaller firms the desire to do UAT testing, and these kind of on-demand environments are absolutely perfect for that. There are times when a client's moving into a new market or even a new location, and they don't really want to commit to we're going to build a production system within this time and have it ready. Maybe they just have some strategies or some algos that they want to test. The advantage to doing this, unlike doing it with a hyperscaler or an existing cloud offering, is that these are trading specific systems inside the exchange right next to the matching engine. So they can easily spin up an on-demand, either bare metal or virtual server, test their algorithms on it, do whatever they need to do. And if they then decide that they want to convert that into a production environment, it's very easy to do. But I guess that the main point is they can do it without any risk. They can do it without having to make decisions on whether to commit capital, etc. So we have seen a fair bit of demand for kind of UAT and testing environments as well.
Thanks, Rob. We talked a little bit earlier about, well, we touched on regulatory compliance, and obviously that's going to be something that a lot of our members be conscious of. I guess I'm just kind of curious that how Beeks deals with that side of things. Outsourcing has become a big topic of discussion among regulators the last couple of years. Yeah, what's your experience in that area?
I would want to ask another question of this, just so I'm understanding it correctly. When you say the regulatory environment, do you mean dealing with different countries when we're going to those to work there and the exchange, etc.?
Yeah, that's right.
Right. I think so. This is going to differ. It's probably going to differ for a lot of people, even within Beeks, as they deal with different clients in different places. I think the big learning we've had, though, in many respects, is that it's never quite the same. It's all about how you can engineer the skills in your team to be able to deal with those unknowns the next time. So, regulations can be really strict in certain areas, and then they can be surprisingly lax in others, according to different environments. The main thing, again, is it's the experience, I think. When we started this, when we signed with JSE years ago, there was a lot of learnings there, just in dealing with the regulations in a country perhaps that we hadn't had as much experience with. And then that's only continued to grow. And really, in many respects, probably a lot of the people here working in the industry will know regulations aren't really going away. It's not something that you're not going to have to deal with. But what we've been able to do is, even if something isn't the exact same, we have cultivated a lot of that skill set in the team and a lot of the institutional knowledge of how we've dealt with it in the past. Again, harkens back to an answer I gave before. But I think, when you've not dealt with an environment like that before, it's really difficult to spot what's coming, and it's always going to be difficult. But if you've gone through it in somewhat similar places multiple times before, and you've seen it from conception to build to live, you're able to start spotting things around the corner a little more. You're able to start planning a little more effectively and ensuring that those bottlenecks aren't happening. Because generally speaking, it can slow you down more so than it can really stop you in your tracks. So it's about just making sure that you're one step ahead of that. And that's about leveraging previous experience, I think, in many respects.
Makes a lot of sense. We've only got a couple minutes left. I don't know if you guys have anything finally you wanted to say. Is there anything that we haven't covered? Sorry, really putting you on the spot there.
I was just going to say on the regulatory question, it's not specifically regulatory, although we have seen situations where certain requests like data must be stored in country. So sometimes we get requests like that, and we have to kind of spin them with the products that we have available to serve that particular market. But that's easy enough. But what we are noticing in terms of trends, please bear with me on the regulatory bit here. We are seeing particularly some of the larger banks who are tired of dealing with, it's probably more compliance than regulatory, but dealing with fairly heavy security and compliance requirements that are looking to offload that. So kind of offloading the risk, offloading the responsibility. We have seen a fair bit of that. Some of that has crossed products that we already offer. So Beeks already offer, automated patching and security scanning and some reporting around that. And that takes a big burden off, some of the people who normally have to manage these things themselves. We've also seen a slightly newer shift to organizations that say, we also want you to manage, the operating system level, which isn't something we've typically done. We've just done the infrastructure side. So we are seeing a trend with that as well. So I think while that doesn't specifically touch on regulation, I think it does cover compliance and risk, and it's all kind of part of the same package. And we are seeing a trend for organizations to want to outsource that.
Yeah, that just to add a comment, that's very unexpected. That we're seeing, pretty serious financial market players down here, James, saying that they want us to manage more. They want us to do more. They want us to manage operating systems and security, and they're telling us they don't want Unix system admin teams and stuff like this. So that was a bit unexpected from us, the extent that they want to offload and then how do we pivot and accommodate, and yes, still have from a product development perspective, a standardized offering. That's something that wasn't expected. So it's a good point you raised, Rob.
I think just to add a little bit there as well, it's something much like Alf. It's somewhat unexpected, and it's become more and more the trend. I've had several conversations in the last few months about this, and though it's a challenge in many respects because you have to add another quiver to your bow and ensure that you have another offering there, it also means that you're becoming more and more integral to those clients. So if you're providing yet another layer of service to them, you're becoming more and more irreplaceable, essentially. And that's something that we find the on-demand model is really good at, because it's a low-risk, easy thing to get involved with. You can take the step in. You don't have to have too much of a commitment. It's flexible. And then over time, as you enjoy it and you find that it works for you, you can grow it. And often that happens, borderline subconsciously with clients, as they just say, well, we'll just take more. And then the conversations start becoming, well, what else can you do for us? Because we like what you're doing. So in a way, that's the strength of this model as well, coming full circle. If you're able to get people into this specific model, and it's designed with those low barriers to entry to be easy to do, or as easy as possible, it's then so much easier to become a really critical partner to those people, because they're already with you. They already have the contracts in place. They already know you. They have positive experience with you now, hopefully. And so that kind of feeds into itself, and it sort of feeds this narrative that we think this model is the future, because it's that ability to become the most crucial partner to these entities.
Yeah, that makes sense. All right, thanks, guys. Hope this wasn't too torturous. I certainly enjoyed myself, but then I just got sat back and asked questions, mainly. So it's not a difficult job for me. 2 minutes left. If anyone wants to say anything finally, otherwise I'm just going to thank you and close the call.
Yeah, James, I'll add a closing remark if I may. I think we've discussed quite a bit there, shifts, trends, pain points for firms accessing exchanges. I think all this stuff is real. I think on the economic and the geopolitical front, I think those shocks are going to continue. But I think the competitive advantage going forward is going to go to those firms, those vendors, and those exchanges that are willing to do a bit more innovation than others. I think that the treasure is going to go to those types of firms that take the risk, as you asked me earlier, and lower the barriers, or increase the speed to accessing the market and do things like this. So I just wanted to leave your exchange audience with that message to finish off for the day.
Thanks, Al. Okay, on that note, thanks everyone. Thanks everyone for joining. There will be a recording of this webinar posted on the website as well, in case you missed anything, you want to go back. And if you want to get in touch with the Beeks guys, Google them, I guess, is a good start to do. But if you want to contact me, I'll put you in touch with Rob and Graeme as well, if that's helpful. All right.
Thank you, James. Thank you, everyone, for coming.
Thanks, James. Thanks all.
Thank you. Bye-bye.